Alright, now we are bang in middle of earnings season. 12th is the day when we'll hear from TCS, Infosys, Wipro, and we've already heard from Accenture. So after a good grand 2021, are we in for another good year of gains for IT? The sector is expanding, buybacks are happening, and growth is there. And Accenture is saying margin problem is also not there. But is this scenario in the price? We've argued this, that markets look forward. Are markets pricing in, or IT stocks pricing in a perfect 2023? Let's discuss, let's debate that with Vikas Khemani. We've invited Vikas to discuss technology today. Why? Because Vikas has really hit it out of the park when it comes to investing in IT for his clients, and his fund has given excellent returns largely because of his over positioning in IT, which has been a super duper call, and we've discussed this with him on why he remains bullish on IT. So Vikas, now it's time to do a reassessment. It's the beginning of the year when we reassess the macro, the environment, the valuations, and the prospective returns. Given what we've heard from Accenture, and given that IT stocks have been racked outperformer, do you think IT stocks are factoring in and pricing in a near perfect FY23?
I think clearly, if you can see, one thing is very clear, whether it is Accenture commentary or commentary from any of the players, that demand environment is very, very strong. And whenever the demand environment is that strong, it is never for a shorter term. It is, and we all know that every organization is forced to spend money on cloud migration, digitization, and many more, aspects of, technology. And this is never a shorter term. And in fact, most organizations have just begun to spend. So according to me, this is not a short cycle. It is a very, very sort of long cycle, which will last probably 3 to 5 years and maybe more. Right? Now, of course, first part of the year, when you saw a big re-rating happening on most of the IT stocks because of the change in this demand environment. So large part of the re-rating probably is behind us. But I still feel that, the earnings growth, compounding is still ahead of us. And I would be worrying about any kind of de-rating or slowdown or factoring in when there's any sign of slowdown in the demand environment, which right now is not visible from any aspect. In fact, only you're getting more and more evidences of a strong demand environment. So if that is the case, you will find this being in the interest in the portfolios. And by the way, very interesting part, maybe there's a lot of skepticism still. IT is not overweight in many portfolios. In fact, if you look at overall at the index level or at the sector level, most of the FIs are still significantly underweight on IT. So it's not the sector is over and owned for us to start believing that a lot of things is already factored in. So whenever there is a good demand environment, under ownership, and continued sort of traction on the sector, I don't think one should worry about it.
So what is the right way of looking at the IT super cycle, if it is a super cycle, which it is? Look at the basic companies, the big four. Look at niche IT companies because they are differentiated and they offer products, or look at a combination of consumer tech or fintech or a product-based company.
I think, Nikunj, both segments are very, very different. There's even IT services, and don't confuse with that consumer tech and platform players and all. Tech and platform players are very, very domestically oriented. They both have a very different demand environment, operating environment, clearly. So if you look at IT services first, I think IT services, you will, across the board, you will find stocks doing well. And we've been speaking about this, for long, across the board. Now, of course, larger company, given their base, will have a slightly lower growth, and smaller company, mid-cap companies can have, given their base, slightly higher growth environment. And whenever such kind of broad-based environment happens, because right now there is a strangling for it is not buyer's market, right? It is basically the demand is so strong that companies are getting away with the price hikes, companies are getting away with a lot of things. So in my opinion, broad-based companies will do well. Again, one has to invest into based on the risk reward appetite, but I feel that many of today's mid-cap companies can become large caps of the future. So this is the kind of tailwind we have. Of course, we have always in our fund maintained a balance of both, a bit of a large companies and a bit of a smaller company. Many of the mid-cap companies have become 3x, 4x in our portfolio. So I think you have to constantly study the individual company, their own strength, what is the business strategy, because whenever there's a sectoral tailwind, you still have to do stock picking. You have to still find the best managements to capture those opportunities. It's not that just because there's tailwind everybody will do well, but while everybody will do well, some people will do exceptionally well, and you are looking for companies which can scale up to become future mid cap, future large caps, and that is the real opportunity if you ask me in IT services space.
So if IT stocks fall, will you be a buyer in them? And then what is that point at which you would say that I'm going to be a seller, whether it is because of environment or whether it is because of valuation? How far are we away from what could be called as peak valuation or frothy valuation for IT sector?
See, you have to understand, Nikul, first of all, these companies are nowhere close to any, frothy valuation. Please understand that, these are free cash flow generative. Another way to look at that, compare with, let's say, another consumer company. How different it is. I mean, these are actually better ROEs, better, demand environment, better cash flow conversion. And you compare, let's say, to any consumer company, right? So in my opinion, there's a long way to go from it as far as the valuation is concerned, according to me, as long as the demand environment remains solid, buoyant, and positive. And we will be constantly tracking about how the demand environment is, how companies are guiding, how the order book accretion is happening, what is the spending pattern globally, companies are kind of adopting. So those are the real tracking to be done. After that, at least we will not worry at this point. We don't think IT sector is in overvaluation zone as it is being called out by many people. We've been saying this and we'll continue to believe that, and that's the reason it's a large overweight position in our portfolio. We still think that it is at least some time away, 2-3 years away. Of course, I am not saying that investing you to constantly keep watching about. Good comfort we have is that it's a structural in nature. It is likely to last for many years. After that, you have to constantly tactically keep looking at everything in detail and look at the data points. But currently, I don't think, in my opinion, it will be disservice if people will get worried about valuations and look for sort of reducing position. In my opinion, it's not that. And secondly, one must understand that it is also a natural hedge in your portfolio. Today, there's a big talk about in a global environment, if interest rates go up and, let's say liquidity tightening happens and, currency also sort of weakens. This is a very natural hedge. And I don't think if, let's say, and in all developed markets, growth environment is very, very solid. So I don't think there's any case for slowdown in the demand environment for IT sector. So in that sense, I feel there's a good sort of case for having a sizable large position, in your portfolio. And still, we don't see that reflecting in many portfolios, both for domestic as well as the international investors. And we think that that will change, in times to come, maybe next 6 months, 12 months. And as that happens, most IT stocks will get further re-rated because IT services companies don't raise capital. In fact, they do buyback. So your available stock keeps on going down and demand keeps on going up. And that's a sort of clear-cut case and that makes a re-rating take place. So we still, in fact, feel that IT sector will get further re-rated. Forget about de-rating. So still you have a money to be made from re-rating as well as the earnings growth.
Sure. Vikas, there are services, there are products, and then there are companies like a KPIT, for instance. They incubate some disruptive technologies to gain an edge, command higher multiples. So then there are companies like those as well, wherein perhaps there is possibility or elbow room for realizations to go up. Wanted to understand the case of KPIT Tech in specific with you, given that the stock has moved up, 25% in just the last 5 trading sessions and about 45% in the last 3 odd months.
You have to pardon me on commenting on a specific name. But see, again, as this technology wave is going on, there will be lots of new business models will come. Like, SaaS is a new model which is coming about, and you will see many companies coming from India from now. We have not even seen them coming into the market. Product companies will come, and you will see over the next 5-7 years, many companies will scale up and become significantly large companies and, compete with some of the international companies. And it is a big sort of move, in my opinion. So tech basket per se will expand big way from IT services to, as Nikunj was saying earlier, on the tech platforms, and also within the software, also more product and SaaS kind of solutions, which so far was considered only domain of, I think, US-based companies. But I think that is slowly moving, and we are seeing many interesting companies coming about Most of them are still in private space, but you will see many of them coming to the market in times to come. So it's a sort of as you rightly said, that in a product company, in a platform oriented company, operating leverages are very high. So as the scale builds up, as growth builds up, your profitability kind of tends to go up, and that's the reason they tend to trade at a higher valuation than a traditional IT services company. So so one has to look at, in my opinion, tech will become a very large part of the overall market, market cap over next 3, 4, 5 years. We are already beginning to see, but what we have seen is only a tip of the iceberg. I think we will see much more in times to come.
Sure. Vikas, considering that we're on the brink of, earnings season and IT bellwethers are going to be reporting soon, just wanted to understand, while demand clearly is looking robust, companies have been alluding to supply side pressures, and mainly attrition as well as wage inflation has been one, key risk. Wanted to understand whether you believe that these issues are well in the price, have they bottomed out, or do you think wage inflation and attrition continues to be a big risk factor going forward too?
So I think, in my opinion, this wage attrition and wage inflation has been, sort of overplayed by the market as a concern. And in the process, those who played this have lost or missed out on an opportunity. Again, I will say I have run a business myself, right? We were in a strong demand environment. And in that period, in my business, which was a broking business, there used to be huge attrition. Every time somebody came and he kind of, I used to lose people, right? But we never lost margin. We never lost, because the demand environment was very strong. Our ability to hire people, train people, bringing them quickly up the curve and start getting to services is there. And also, most of these companies, if you see, over the years, they have dealt with these issues of attrition. They have dealt with these issues of training. It's nothing new for them. And they are solid institutions. So if you see today, companies like Infosys, TCS, they are, or all other, for that matter, large companies, are spending massive amount of money in training and retraining their staff. If you go to any of the campuses, there are 1,000 rooms where trainings are going on, right? So two good things are happening. One is that price hike is easily available, or is available from the customer end, because there's a huge demand environment. Secondly, when you are retraining a staff, right? Also, what is happening is that you are, training freshers to cater to a high value job. So to that extent, your cost of services are not as high as they would be in traditional. So I think people, in my opinion, forget to understand this part. And like, from my experience of running this business, I can tell you, if let's say I lost a salespeople where you would pay 20 lakhs rupees salary, we would replace it, from the bench. So somebody who was getting 10, 12 lakhs rupees salary, he gets high growth. He gets, so he's more motivated. And company cost does not go up. So I think here the operative thing is to understand, very, very importantly, is that most companies are spending huge amount of time, effort to train, skill their staff to cater to this new demand. And that's where, if you see, all these companies have hired, freshers in a big way. So I am not a big believer that there will be a big knock in the margins. Of course, 1 or 2 quarter here and there, a few basis points here and there will always happen, because nobody can predict quarter on quarter. From a trend perspective, I'm telling you, these concerns are, in my opinion, unjustified. Key thing or key word is to constantly keep on watching. Is the demand environment very strong? As long as that is there, in my opinion, everything will be taken care of.
Okay. Vikas, on those confident words, great to have you in the show as always. We'll let you go on that note.
Thank you very much.